All right. All right, we'll go ahead and get started here. Come on.
Recording in progress.
All righty, welcome everyone to tonight's Sunday macro wrap-up for Sunday, February 16th. We had inflation data come in last week, so we're going to go over some of that, as well as some things that I'm just noticing, developments. There's some longer-term trends that are also forming right now, so we're going to go ahead and go over those as well. Some pretty important stuff. There's a lot of mixed type of sentiment that's out there as well. And so it's really important during these times where it's very uncertain, right? You have everything that's going on with the Trump tariffs. You have everything that's happening with just the uncertainty in the markets in general. And so it's really important to have your metrics that you pay attention to so that you can fall back on those and that you don't get too wrapped up into all the craziness that's going on right now. So we're going to be covering some of the stuff that I'm looking at, as well as I was mentioning beforehand, before I hit record, that there's this longer term indicator that I like to pay attention to. And it's made a move that we really haven't seen for about a couple years now, that typically front runs downturns in the markets by about 6 to 8 months. And so that flashing has really set the timer on what has a high probability to come. And so we'll go ahead and get into that as well. And so taking a look at some of the macro highlights from last week, first we had the Small Business Optimism Index. This had a large acceleration in the month of December, similar to what we saw during Trump's first initial term during his election. So this was back in 2016, the red circle on the left. That is showing similar to what we're seeing right now with the optimism that's going on. It has come down slightly since then, and so kind of similar to what we saw last time. And so this could continue sideways, but the optimism for small businesses is something to really pay attention to, especially now that we're in a period of higher than average interest rates. And so if this optimism starts to fade quickly, meaning we see this metric starts to come down, that would really put some pressure on the growth outlook for the United States. And then, of course, last week we received more data for the CPI, which had a hot print. And so that accelerated for the fourth month in a row, and it came in hotter than expected at around 3%. And then core inflation remained unchanged at 3.3. And then also too, when looking at producer price index, so the PPI front run CPI, and it's important to pay attention of PPI because this is the inflation measure for producers. And so this is an early indicator for a lot of the inputs in the economy, and that does continue to accelerate. And so I do think that we're going to continue to see inflation remain sticky. We could see a slowdown in other components such as oil, right? So in our model, oil just went bearish. And so that is one of the more volatile components of CPI, namely the headline CPI. And so if you do see a large slowdown in oil prices, as well as energy in general, then that could bring the CPI down even further. So, we'll continue to pay attention there. Right now, the market is really hoping for lower inflation because that would be a signal that the Fed could continue their rate hiking regime, which we'll get into the probabilities here in a second. And then on Friday, we had U.S. retail sales. This is one of the best leading economic indicators for consumption in the United States. And so, when seeing that, I'm showing this headline right here because these headlines are hilarious because they only look at month over month data and they don't necessarily capture the entire move on a year over year basis. And so whenever you see these headlines, that's why we don't try and react to headlines, because namely they're just trying to promote a certain narrative. Because if you look at retail sales on a year over year basis, which is what matters, that went from 4.3 to 4.2. So only a 0.1 year over year decline, and it still remains very much higher than the average of last year. And so just be aware when you see these headlines, post biggest drop in nearly 2 years. That's not the biggest drop at all. So to me, this is showing that the consumer is still staying strong. Inflation is still staying sticky. And it's just round and round we go with this loop of inflation accelerates, then the Fed gets more hawkish, and then stocks possibly sell off or go sideways for a while. And then that causes inflation to come down, and then stocks go back up, and then it goes round and round that circle. So we're just in that phase right now where inflation is higher and the Fed is more hawkish. And so taking a look at the inflation outlook, according to the Cleveland Fed, they have a 2.8 handle for headline CPI. They, of course, missed their expectation for last month. And so seeing that, they're having a little bit of a hard time tracking this, that's the reason why we like to track our other inflation gauges as well. And so we do see headline CPI coming down slightly next month, only because of oil prices. But again, having a large fall in inflation is unlikely. And then taking a look at the target rate probabilities for the March meeting, that remains at highs at 97.5% chance that they're going to pause interest rates, continue their pause in March. And really, there's not a probability of them cutting, at least by just 25 basis points, until the July meeting, as of right now. Again, if we start to see inflation come down or growth demand getting worse than it is right now, you could see the Fed cutting sooner rather than later. All right, and then in terms of next week, when looking at the Forex Factory macro calendar, you can see that we're going to get Empire State Manufacturing. This is one of the leading manufacturing indices to watch. And then we get some housing data. And really the main ones as well is on Friday, we get Flash Manufacturing and Services PI. So not too heavy on the macro data. Of course, unfortunately, right now, because of the uncertainty with the current administration's tariff policy, all the announcements that are made, it's unfortunately a headline-to-headline type of environment right now. But like I mentioned earlier in this video, we don't want to necessarily have that slosh us around, because we're going to be in and out of trades, and every trade isn't free. There's always fees associated with it. So even if you're going in and out in things and you're breaking even on like the percentage basis, you're still losing money because of fees and different things like that. So you just have to be careful and always fall back on your process when it comes to the day-to-day noise, as well as making sure that we're keeping in mind the longer-term trends, which, if we take a look at the Chicago Fed Financial Conditions Index, that continues to draw down, which is good. So when this is decelerating, that means that the financial conditions are very loose. Also as well, M2 money supply continues to accelerate, which is also what's contributing to inflation accelerating as well. When we take a look at bank credit, that also has had a rebound since January, and we're now back at 3.9, which is the top that we saw back in mid-November when the S&P 500 was at its near its all-time highs. And so it's no surprise right now, and because of last week, that we're seeing the S&P back near all-time highs. And also, as well, looking at the private sector, we get the new banking conditions survey this week from the Dallas Fed, but this is looking at the December report, and that had a very large acceleration in total loan volume. And so the reason why we bring up the credit markets, both public and private, is because that typically is a leading indicator for financial markets. And so, as we've been seeing, we have financial conditions very loose. We have loan volume accelerating. We have bank credit accelerating. We have the M2 money supply continue to accelerate. So, all the people that are calling for the Fed to cut rates so that they can print money, money continues to be printed already in the credit markets. So, there's already shadow quantitative easing going on within both the private and public banking sectors. And so, what I want to remind people, and this did come up in discussion last week, is that the Fed won't do all out quantitative easing until interest rates come back down to zero. And who knows with this high inflation environment post-COVID if we'll ever get there ever again. And so the full-blown QE is always the lever of last resort. And that won't come until something really bad happens in the economy. And so what do? They use private as well as public debt, as well as the Fed has different levers that they can use, such as the discount window and other things, which can put band-aids on things momentarily, but that could float the markets for a few years still. And so for those people who are very hung up on the Fed printing money, there's already been money printing going on this whole entire time. One other financial stress index that I like to look at as well, and typically when this is accelerating, this is a great leading indicator too. This is the St. Louis Fed's Financial Stress Index. And so this is on their website here. And whenever this is accelerating, similar to the Chicago Fed Financial Conditions Index, the St. Louis Fed Financial Stress Index, whenever this is accelerating, that's typically bearish for the markets. And whenever this is declining or when it's negative, that's typically more bullish for the markets because financial conditions aren't stressed. And so as you can see right now, zooming in here, pretty much this has been falling since August of 2024. It did have a spike. That was during the yen carry trade freakout. I don't know if you guys remember that, but we saw an acceleration of this in mid-July, and that was when the market had a decent sell-off from that point all the way into the beginning of August. And so we have to be careful right here because we are at the lower bound of this financial stress index. And, so we just have to be aware that this could have, a spike upward even momentarily, if it comes back down, but just know that we are at the lower bound here. And then I don't know if you guys have been paying attention to the new Treasury Secretary, Scott Bessent. He's been talking about reversing a lot of the policies that Janet Yellen did over at the Treasury. And what Janet Yellen was doing, as you can see from this chart here on Treasury security issuance, is that Janet was issuing a lot of bonds on the short end of the curve in order to fund a lot of the bad stuff that was going on. And so normally, you would want to issue more bonds, which is on the long end of the curve, so like 10-year, 20-year, 30-year bonds. But Janet Yellen has been doing Treasury bills. So these are short duration, 1 year, 2 year. And so with this blue line accelerating, that just happens to coincide when this started accelerating here, the short duration Treasury bond issuance. That was right around the time when the market bottomed in July of 2022. I can zoom in here a little bit. Wait, hold on. And so as you can see, this started accelerating right when the market was bottoming last year. And so as a lot of people like to think themselves like, okay, the markets are doing well, a lot of it is just government spending as well as a loosening in the private as well as public financial markets. And so that's why we track this stuff, is because once you start to see a tightening, that typically is when you want to get out of the way. And so that's just the credit markets. And we also want to pay attention to debt as well as growth as well as inflation. But really, the debt markets are the most important in my view. to track, only because we do live in a more debt-based society. In the United States, the production has been going down for a while, and so productivity rather, and so we've been having to fuel the deficit with more and more debt. Going back to, actually, let me see here. What was interesting was we saw a large drop off, and this could be because of the current administration's trade policies that are going on. But we've seen a large, unusual drop in the containerized freight index, which is showing that global shipments are dropping, and so this could mean that supply is higher than demand, or there could be some trade policies going on that are disrupting it. Right? I mean, you see it right at the beginning of January of this year. It just has been dropping off like a rock, similar to what we saw back in August. Now, this metric typically has, you can read it in two different ways. This usually has a lag on inflation by about 8 to 12 months. And then also, too, you could see it as a coincidental global demand signal if this starts to really drop off here. And so similar how this peaked around December of 2021, and this started to come down. I mean, that's when you had a huge drop off in global demand. That's also when we had a bear market in the S&P 500 and markets. But also, too, this peaked about 6 months to 8 months before the peak in the CPI inflation. And so you can just see from looking at this chart that over time, inflation is going to come down, but also, too, that comes with global demand slowing down as well. Now, getting into all this great information is awesome, but let's talk about some assets here on things that we can actually invest in. Obviously, one of the big ones has been gold as of recently. And so there's this awesome website called the World Gold Council. I don't know if you guys have ever heard about this before. It's one of the sources that my team and I uses, but you can create a free account so that you can get these awesome reports here. But on February 7th, a couple weeks ago, they came out with the gold reserves report from 2024. And so what's interesting is that, and this is just taking a look at global central banks, they have been stockpiling gold like crazy. And even before the pandemic, pretty much since it really started accelerating in 2022. But it looks like that just the global demand for gold is just going absolutely crazy. And you're not just seeing this in global central banks, but you're also seeing it in private banks as well. And so this is the COMEX Big Three Vaults for Brinks, JP Morgan, and HSBC. And what's really interesting, this is a tweet from Finance a Lot on Twitter. And this was because I usually like to scroll through FinTwit just to see what's really interesting. And this chart was really popping out at me because if you can see here, it's a little bit slim. But as you can see, over the past probably 3 months, there's been a rapid acceleration in the stockpiling of gold in these large Big Three vaults. And the last time that we saw a huge acceleration like this was during COVID, right? And it did happen a little bit before COVID even happened as well. So it's a little bit suspicious there. But ever since then, it's had a drawdown. But as of recently, over the past few months, we've seen just a rapid acceleration back to all-time highs in the amount of stockpiling in gold. And this is in private banks. And so not to say that this is going to say anything or we're going to have another pandemic type of thing. But typically banks just don't do this. And so it's no surprise that, gold prices have also been accelerating by a lot because the demand is just incredibly high right now. And I don't see this slowing down anytime soon. In our models, we went bullish. We went back to bullish on gold on January 10th, and since then it's up about 7%. And I've been looking for another point to buy some more because I just think gold is going to be continuing its acceleration here. So Um, that was very interesting to see that. One other thing as well, just taking a look at the sectors of the S&P 500. The best ones, we saw a rebound in tech last week. And that could be, a lot of people were asking, why is Nvidia going back up? Why is the S&P 500 back at all-time highs? Well, I mean, it's up because it was down, and we continue to tread sideways. And so, yeah, I mean, it was even with the CPI number last week, there was still some optimism that looking at forward inflation expectations, those would be coming down. And so we continue this era of bad news equals good news, because if inflation is coming down and things are getting worse, then that's a higher probability of the Fed cutting interest rates. And so it is interesting to see this rebound in the tech sector. If we go back on 1 month performance, the best one that's been performing the best is communication services, which does hold things like Microsoft, Nvidia, a lot of tech in there, as well as financials. And just like how we talked about how there's a lot of credit expansion going on, all those things, it's no surprise that financials is the second best sector that's in bullish trend right now. Energy is the only one that's struggling behind. And then looking on a 3-month basis, again, communication services remain the top one. And this could also be explained because communication services, as well as XLK, have a very large allocation towards the Magnificent Seven stocks, which, as we know, there's a large concentration in there. You guys have heard this before. As well as it's not just the United States that invests in these big 7 stocks, it's really the entire world. And so not only do you get that support, but also, too, you have the passive flows from a lot of these target date investments. And that really doesn't become a headwind unless we really go into a full-blown bear market, which we're not there at all. And so our model still remains bullish on Qs as well as the S&P 500. The only time it really went into neutral, actually Qs hasn't gone bearish at all or neutral. It's stayed bullish for this whole time. And then the S&P 500 did go neutral for about a day before it went right back to bullish. So in terms of the market, our signals are still showing that bullishness remains. And so all that being said, it is still interesting how when we take a look at seasonality, so this is a chart by Charts Equity Clock. And this is another free website that I like to look at. But typically in February, it's pretty much a flat month. Usually you have an acceleration in the first half and then a deceleration in the second half. Now that's not every single time. This is just seasonality. And it doesn't perform that way all the time. But typically the start of the year, especially January and February months, are a little bit weak. And, the beginning of March could be weak as well, but then it really starts to accelerate for the rest of March and into April. And then once you get the sell in May and go away crowd, as well as in June, when volume starts to come down, you see that we go back to treading sideways seasonally between May and June. And so if this optimism continues, then we could see the S&P 500 as well as tech stocks continue to rally from here. Especially if you start to see that a lot of the Trump tariffs aren't as bad as a lot of people think. And so seasonality is something to definitely keep in mind as well. Now, going to the charts here, let me just switch over. Looking at the charts, we see that the dollar has been coming down a lot. And this could have a lot of different things. You have to look at this in terms of what's also positively and negatively correlated to the dollar. And, I have a correlation matrix that I like to look at. I won't bring that up right now, but really the things that are most oppositely correlated to the US dollar are international equities, which have been performing very well. I mean, if you look at a chart of Poland, for example, as well as China, those have been doing very well. And then the assets that are positively correlated to the dollar are things like Bitcoin, not as positive, but still more positive than usual. You have things like agriculture as well as, let me see here, consumer staples, natural gas, and oil are more correlated to the dollar right now. And so if we continue to see the dollar come down, that could have a short-term optimism for risk assets, which, we've already been seeing that for the past week or so. And so we always want to start with what the dollar is doing, because if you understand where the dollar is going, you can get a lot of other things right. But just like if you were reading a story or anything, you want to make sure that you're reading it in context. And so when you look at the dollar, note what it's doing, but then contrast that with what we're seeing in other different asset performances, such as the U.S. 10-year government bond yield, which continues its downtrend here. It made a lower high. And so this, in our model, is signaling more of a weaker growth scenario, which is why we're more so leaning towards a stagflationary environment, which would make sense because gold has been the best performer, and usually gold does very well in stagflationary environments. And so, again, this could pose some short-term optimism in a lot of the tech stocks that continue to move higher. And so, looking at the volatility index of the S&P 500, this remains at the lower bound. And so we were raising some cash on Friday as the S&P 500 was inching towards new all-time highs. And it's important to also have, with all the macro stuff that we talk about, it's important to have the math also confirm that. And so, the math hasn't changed in terms of bullishness. And if you were able to keep that confident, or if you were able to see that math, it would help you with your confidence with buying dips. And so far, that's been the correct move, not only in the S&P 500, but also with Qs as well. And so we'll get into some of the other assets here momentarily. But also what I wanted to show is this indicator here. So this is the OECD CLI Diffusion Index. And we're looking at the S&P 500 on a monthly time frame. And so as you can see, this goes all the way back to 2013. And so if I overlay that with this OECD Diffusion Index, what's interesting is that you have the month-over-month numbers in blue and the year-over-year numbers in orange here. And so what's interesting is that typically when you have a cross, when the month-over-month crosses the year-over-year, that's typically anywhere between 12 to 8 months before the peak in the S&P 500. And this is historically, obviously, it doesn't happen every single time like this, but it fluctuates. And then once you start to see the month-over-month start to go down, that's about 8 to 6 months. And then once you start to see the year-over-year start to decelerate, that's usually 4 to 6 months. And so as of right now, we've gotten numbers for both January as well as February for the year-over-year, and that had a very large deceleration that we really haven't seen in quite some time. We haven't seen this since 2021, essentially. And this is a metric that we've been looking at beforehand. And the reason why it's important is because all the macro factors that we take a look at, manufacturing, goods, inflation, all those different things, it takes a look at that for not only the United States, but a lot of the other G7 countries as well, and puts them all into one aggregate indicator here. And when I see this, we had the cross back in June of 2024, which, like we mentioned before, that's anywhere between 8 to 12 months. And then we just started to have the year-over-year start to decline as well, which puts us around, summer of this year, where you could start to see not a bear market, but maybe some headwinds as well. And that's just from looking at this indicator. It's really interesting how some other people who have their macroeconomic models as well, they take a look at the debt cycle that's happening right now. So there's trillions of dollars in debt that has to be refinanced this year at these higher interest rates. So it's rolled over debt from COVID, and not just private sector debt, but also public. And if it has to refi at these higher rates, that could be a bad situation. And so it's just interesting how we see all these different metrics showing that there could be some larger headwinds around June or August of this year in 2025. Now, again, that could change. We will have to see. I typically like to see at least 3 months or more of this, and so right now we've only seen 2 months of deceleration. So I wouldn't technically count it as a trend just yet. But if this continues to decline even into March, then we just have to be cautious and just really be able to put our trading hats on instead of like our long-term buy and hold, set it and forget it type of mindset. And so, yeah, I mean, that's what I'm seeing right now in terms of the short term and the long term. When taking a look at the best performing assets of last week, let me see here. So the big one was natural gas. So UNG is the preferred ETF that my team and I likes to use for natural gas. And so that remains in a clear bullish trend, and it had a large acceleration last week. And so, we should continue to see this accelerating. I don't see this really stopping anytime soon unless you just had a huge drop off in demand. But that was the best performing asset last week. Next was XLK. So this was a rebound in the tech sector, which was, again, front run by a lot of the, or led by a lot of the Mag 7 stocks. And so we continue to see that back near all-time highs. And then, like I mentioned before, XLC, so communications, and that continues to make all-time highs here. Taking a look at the mega cap tech stocks, Apple remains in bearish trend, even though it's had its pop here. We'll see if it is able to continue, and we'll bring that to neutral or bullish next week if it continues higher. Microsoft remains bearish. NVIDIA is neutral. This could reclaim bullish trend if it continues higher. I was waiting for it to close above that $134 mark, and so depending on where it opens yesterday, I'd be comfortable if it does have a little bit of a correction, maybe taking a shot on NVIDIA. But I did wanted to confirm that it got out of its bearish trend, which it did. So we'll be cautious there. Amazon, despite it having a little bit of weakness over the past week, last week with other things accelerating, that still remains in bullish trend. And so I was buying some Amazon as well. Google is bearish. Meta remains bullish, and Tesla is bearish. And then let's see. Let's just take a look at a chart of gold, because I know that we've been talking about it for a while. And so it did have a little bit of a correction here on Friday, and it just opened up for the international markets just now. And I was buying a little bit of gold on Friday as it had a large deceleration. You could use the ETF GLD or AAAU for that. I think GLD has a little bit more, it essentially has 5 times more of the volume. So if you want to use GLD, that's a really good one there. And then let's see, what else here? What was... Industries had a tough time last week. Let me take a look at international. So the best performing international equity was Austria. Now, a lot of people sleep on these international equity ETFs because it's just it sounds weird to like buy a country's stock. But really, these if you catch one in bullish trend, it often performs even the large indices in the United States. They obviously are a little bit risky, but as you can see with Austria, just since mid-January, that's up 15%, which that's outperforming the majority of the mega caps as well as the S&P 500. And so that's why it's important to have this type of macro model for yourself, so that you can just, invest in any type of market, regardless of, what your favorite tickers are doing. And so, catching this early, being in bullish trend, even if you missed out on this leg here and you're able to buy in, lower, that's still a decent move up over 7%, which is more than you're getting in the S&P currently. The other one was China. So we'll go to GXC. China is another one that's been having a bullish rebound. It's been, ever since it had its large acceleration in September of last year, it's kind of been going downward and then recently recaptured bullish trend here after closing above here. So I'll be looking for a pullback in China in order to make a position there once it provides the opportunity. And then I think that's pretty much all I have for the stream here. And so for those who are joining on YouTube as well as Instagram and TikTok, if you guys want to join, because usually the way that we do these Sunday macro wrap-ups is the first 30 to 35 minutes. We have it streamed live on our social medias. And then the next 30 minutes or the next 45 minutes is only reserved for our members. And so if you guys would want to start a free trial of that, you could just go to the link in my bio and you can start your free trial there for our school community. And then we're also offline here in a second. We'll get into some of the positions that I'm personally looking at too, either that I have and I want to buy more, or some of the stocks as well. So again, if you guys want to learn more about that, just go to the link in the bio there and check that out. But for those who are members that are on the call here on the Zoom call, stick around. I'll go ahead and just exit out of our streaming, and then we'll go ahead and answer some questions too. All right, everyone, have a good night on the